Welcome back, ladies and gentlemen. Thank you all for joining me today. We're going to be taking a look at the stocks for September that I'm currently researching. I know it says buy, but there's a couple on here that I'm either going to buy or that I plan on adding to because I probably already have a position in them. But there's most of the time, this is all going to just be research and things that I'm trying to look through and what I'm interested in. And I figured I might as well show you. There's always a couple of things that I'm reading into or trying to learn more about. So I figured I'd do that here on this video. It's for September 2022. If you didn't see the last one, August 2022, you can go check that one out. Some of them cross over, some of them are probably going to overlap in some of the videos. That's totally okay because I'm continuing to research some of these companies because some of them are really complex. So with that being said, let's dive right into company number one, Daily Journal. Now, Daily Journal, as you would imagine, is actually a newspaper publication business that has a hidden SaaS business or upcoming SaaS business, however you want to view it, on their current, financial statements on their balance sheet, but it's a tiny minute piece more so than it will be in the future. Now, really the important thing is they have three segments. They have the newspaper segment, they have the sort of investment portfolio segment, and then they have the journal technology segment, which I'm going to be talking about here today. Now, the investment portfolio is around $350 million, and it has a lot of different holdings, and I'm going to pop up some here. This is going to be the U.S. portfolio. That 13F filing is only going to be U.S. holdings. So all the foreign companies and foreign, different industries and things that are inside that balance sheet, this doesn't make up that full 350. There's only maybe half of that. Now, Journal Technologies is going to be a SaaS business that's on their balance sheet and on their financial statements as well. You'll see it broken out in some of their reporting. Now, really what this is it's an up-and-coming SaaS business that they're trying to move into from their previous legacy version, and they're trying to push courts, and it's a court case database management system. So what it's going to allow to do is basically going to bring everything to the internet and to the 21st century into 2022. A lot of courts still do things by paper, so that's a real issue when you're trying to move files fast. You're trying not to lose track, and you're trying to be able to see where the actual items are in each workflow. So this will allow the courts to do that, and they already have some big contracts, some with LA, some with Austin, Texas, some with Australia. So there's a lot of potential here. Now, the first thing that I want to talk about, the investment portfolio, there's a lot of cash, a lot of liquidity on this balance sheet. And honestly, it's one of the great things about this company is that there's a huge cash position as well as really a marketable securities position that they can sell off if they need the cash at any point in time, as well as they have Journal Technologies. Now, the thing is that this is going to take anywhere from 5 to 7 years per contract to actually start seeing the revenue on their financial statements, because they don't recognize the revenue until they get signed off and say the deal's done. So that's why I think that a lot of these contracts that are getting put through the RFP process currently are gonna be processed here in the next 3, 4, 5 years, and so on, as they keep getting added and added to the sort of the backlog that we currently have. Now, one of the risks that I wanted to point out is that there is an old management. Now, the old management is transitioning out. I believe Jerry and Charlie Munger have kind of given up the reins to the younger folks here in the organization, but we're gonna have to see with that management change, did they keep the sort of, the same way of managing the company, the same way that created the company that it is today, or are we going to see some sort of culture shift? Because there are some risks with the culture. There's been a lot of complaints on Glassdoor, so I'm hoping that at least the culture and the people that get involved change for the better, not for the worse, along with the fact that another risk that I saw was the RFP process. It does take a long time. There is a lot of, if the statement of work is set up in a certain way and they keep adding and adding and adding to it, it's going to keep delaying it. And honestly, you're not going to be able to recognize the revenue on your financial statements until they sign off on it. So you're not going to see anything hit the top line. You're definitely not going to see anything hit the bottom line, because all the expenses are incurred today and they're recognized today, but all the revenue is being deferred to a later date. Now, some valuation metrics that I wanted to touch on really quickly. Their average ROIC is anywhere from 3 to 5% over the last 10 years. Obviously, that's going to change as Journal Technologies comes online. Their PE was around, 18-ish. But again, the price to earnings is really like a hard way to value this company because of the fact that the earnings are going to jump up or down really hard depending on how the portfolio does. So if the portfolio has a really bad quarter, it's going to take a huge hit. If it has a really good quarter, it's going to have a huge jump and it's going to look a lot cheaper than it actually is. So really the way I'm looking at this is I'm just looking at the backlog and trying to value it. I put up a DJCO video not too long ago, so if you want to go check it out on the channel, see how I value this company. Now the way I'm doing this, I own some shares in this company and I am continuing to add to it. I want to get this to around 5%, maybe 7% of my portfolio. I'm continuing to add as it drops. It hasn't dropped really anything significantly. It's very illiquid. There's really nothing going on with this company. It's kind of almost like it's waiting for a catalyst or something to happen, either for the upside or downside. But I'm just going to continue to add as we see some weakness in the overall market, and then the price continues to trend down, because I think that for me personally, I like the valuation anywhere from $350 to $300 million, and obviously anything below that. So I'm just going to continue to add as this thing keeps dropping. I have some limit orders set, so if it hits a certain price, I can actually add to it. But that's going to be Daily Journal Corporation, DJCO. I hope to put out another video if there's anything that really comes substantially for it. But if you want to see my whole thoughts and analysis and everything, just go click on my YouTube channel. It's probably one of the most recent videos. Now, the second company that I want to take a look at is MU, or Micron Technologies. And this is sort of the big value investor play that, is an oligopoly industry and that everyone's into, and the business model is amazing and all that good stuff. Now, what Micron Technologies really does is they create memory chips, primarily memory chips. And there's really only three players. You have SK Hynix, and you have Samsung, and you have Micron Technologies. That's it. That's pretty much the three big players at the very least. And Micron Technologies has had sort of an up and down. They're usually going to be the one that suffers the most in these sort of memory cycles and semiconductor cycles that we tend to go through. Now, obviously, they're trying to stabilize the business. They're trying to get that earnings as more of like a steady line up rather than shooting up, shooting down, shooting up, shooting down. So it'll be interesting to see what they can do over the next couple of years. But really what I want to focus on is the fact that they have sort of a huge amount of backlog, as well as a huge amount of sales that are coming from two segments in general. So what they said is that a lot of the current sales are coming from sort of the computer and retail computer, as well as the mobile chips. But what they see is that coming forward, it's going to have a lot more automotive and sort of, things that go into cars sales. And so that'll be interesting to see. One of the things that I did see is that DRAM and NAND have a really good TAM over the next few years, especially a lot of that's going to be driven by sort of things becoming more technologically advanced, as well as needing more memory, as well as automotives really just coming online and making sure that they have all sorts of tech loaded into them, especially because EV is becoming more and more frequent in cars, and a lot of people are shifting to it. So it'll be interesting to see what that looks like as far as the broader growth. And I'll pop up a TAM that they expect here. This is from their investor presentation. I really liked this though, and they also had another one that they wanted to mention. So I'm going to pop it up here too as well. And really what they said, that there are the market leaders in a lot of different areas, and you can see that here, where they line up, what they think they can do. And again, because of the, where they're at in their marketplace and what they do, it's really hard, and it'd be really, really, really hard to replace this. You couldn't just start up a new business and replace them overnight. It would take a lot of money and a lot of funding to really be able to do this. Now, one of the things that I wanted to mention too on the downside, and one of the risky things, is again, a lot of value investors are getting into this, and they really all see the opportunity. And the thing is though, is that because this is so cyclical, you might see a lot of sharp declines if we have, negative sales growth year over year, or negative earnings growth year over year, because again, the whole semiconductor industry basically goes in a cycle. You have a lot of booms and busts, and what happens is that Micron dips really hard when it goes through one of those bust cycles, but then it rockets back up as soon as it hits sort of a boom cycle, like we saw going from 2020 into 2022. Now a whole year to year and a half span, basically from when the pandemic started to about the beginning of this year, you saw some crazy jumps in all the semiconductors. So Micron's no different in this aspect. So a lot of it's going to come where you understand the business and what the valuation you pay for it is, and what you think it'll go to over the long term. Now, taking a look at their valuation, their ROIC has been anywhere between 5 to 20%. Again, It's very cyclical. It's pretty hard to sort of narrow down over the last 10 years. Their PE right now is at about a 6, but again, if the earnings start to slow down a lot, that PE is really maybe like a 10, 15, somewhere around there. It'll all depend on how stable those earnings end up being over the next year or two. Their forward PE is around 8, and then of course their enterprise value to EBITDA is around 3 or 4. So you're going to see a lot of news stories and things come out about this as semiconductors sort of kick up, and you start seeing other industries come online and things like that. So I think that Micron's an interesting play, but I'm just trying to understand semiconductors as a whole before investing too heavily into this or into some of the other ones that you saw in the August 2022 edition of this video and series. So I'm just trying to read up on it, and I'll try to do a write-up or at least a video on Micron, because I think Micron is a very interesting company, has very interesting management. I think the valuation is very compelling, but I just need to do more research. Now, the third company on my list is going to be WBD. It's going to be Warner Brothers Discovery. This is the spinoff from AT&T, giving basically merging Discovery and Warner Brothers together and creating a large, giant media company. And really what this is there's a lot of mess on their financials, and there's a lot of things that still need to be fixed, and there's a lot of things that still need to be consolidated and all that good stuff. But really what you can see here on the screen, look at all the brands, look at all the franchises, and look at the opportunities that they have. A lot of this, branding and things that they have and channels that they have, a lot of these items have been paid for. So HBO Max and Discovery Plus are going to be their two big platforms that they're going to use to sort of distribute these different sort of channels and things and really content across to a broader audience. And you have to pay for them separately. There have been talks about, combining the two and having one library, or just keeping them separate, maybe having like a package deal similar to what Disney does with ESPN Plus, Hulu, and Disney Plus. They kind of package it all together because maybe you don't need everything from Discovery Plus. You don't need everything from HBO Max. But you can see here that they've kind of gone back and redone their pro forma numbers for the combined company. So you can see here on this next screenshot what actually happened. So you have the studios, and this is how they're breaking up their new segments. You have the studios, the networks, and the direct consumers. So the studios is going to be sort of the movies and different games and things that come out. The networks is going to be your your normal network TV and advertising and things like that. And then direct to consumer is going to be HBO Max, Discovery Plus, and anything that's going to be related to that. So you can see there on the right side, they're about $10 billion in Q2 revenues, and it's really interesting to see it finally getting put all together and everything that they had expected. Now, really the big thing in all of this is that, again, because they're just merging the company, it's very messy. It's super, super messy, but they have a couple developments that I wanted to go over. So one of the things is that if you look down here, they have some key financial metrics and assumptions that they're going to be operating on. I think that these assumptions in the screenshot is more of a base case scenario with chances that it's probably going to end up being a little bit lower in actuality. I did like that they had an EBITDA to free cash flow conversion rate. I do like that. I think that's realistic. And my goal for this whole entire investment is I want them to continue to pay down debt. I want them to be focused on that, laser focused on that, as well as consolidating any of the costs that are being, doubled up on because they have two different studios. Just make sure to consolidate that and sort of get rid of some of the synergies that they can have cost-wise. So they want, though, ultimately they want a 3x EBITDA ratio. Right now they're at about a 5. And you can see on the assumptions that they're expecting peak loss to be this year, as well as they're expecting break even to hit in 2024. And then going forward, they're trying to drive that growth and trying to drive basically everything to the bottom line. And so what I think that if you look at the pro forma EBITDA, really honestly, if you just look at the EBITDA that they're expecting for 2023, because again, they're trying to get free cash flow to about 33 to 50% of that EBITDA number. So let's assume that they get $6 billion in free cash flow. If you just apply a 10x free cash flow to price to free cash flow multiple to that, that's a $60 million company. Just a 10x, and it's probably not even realistic to see a 10x on this company. It's probably going to be higher as they grow out more and more. But again, it's a lot of debt. It's very risky. There's a lot of things that come with investing in this company. It's not just a straight shooter, or else this company would be priced a lot higher because, markets aren't efficient all the time, but there's some things where they price it out probably a lot better than other situations. And this is such a large company and has a lot of people following it that I don't think that this would be something that would fly under the radar completely. So one of the things that I had mentioned earlier, and I think this is a good development point, is their cost synergies. So they're expecting anywhere from $3 billion to about $2 billion worth of cost synergies going forward, and they think that they can sort of make that go up and higher and higher and higher as we get into the later years of the 20s. So what I really want to see, though, is because they're trying to work on their savings and work on paying down debt, see where those opportunities are, and you've already seen them start to cut out things that don't really matter or don't drive really ultimately sales to the top line, and CNN Plus is one of those things, as well as some of the other movies and shows that you've seen kind of getting canceled, or the plugs getting pulled, or they're getting held off. I think that there's a lot of opportunity there, but again, I think that they need to pay off their debt. That's kind of like the most important thing. And speaking of debt, you can see on the screenshot here, they have about $53 billion worth of gross debt, and obviously they're averaging about 4.3%. A lot of them is not maturing for the next 10 to 15 years. So that should be, sort of a good indicator of where they're at. But again, their target leverage is 2.5 to 3 times the EBITDA on the debt. And right now they're at about a 5. So they're expecting to hit it in the next few years. So this is one of those things where it might not go anywhere for the next couple of years until they start showing some more progress on their plans and start showing that the management can actually execute on these things. So this may not go anywhere for the next couple of years. And I mean, I'm totally okay with that, but some people really just aren't. And again, the average ROIC, we don't know. We don't have the numbers completely yet. We'll see once 2022 ends for Warner Brothers Discovery what actually happened, and we can kind of get an idea into what they're doing. But again, they merged the financials, and so we don't have like the full-on numbers yet. And any historical data that you're going to see online is going to be from just Discovery's numbers. So with that being said, enterprise value to EBITDA is about 8 to 9 is where I've been seeing it bouncing between. So I'm looking forward to seeing them actually start to generate some free cash and actually get into this. I do have some positions in this. I think I have 40 shares now of Warner Brothers Discovery. So I'm going to continue to add to this if it keeps dropping, but I don't want to make this I don't want to make myself too overly exposed to this, because again, the debt is really risky. If we go into sort of a negative environment, it's going to get a little bit scary. So with that being said, I'm going to keep buying as this goes down, hopefully, but I'm going to keep researching and trying to understand the fundamentals as I continue to plow more money into this. Another one that I had on the channel, it's been a while since I've talked about this company, is Corsair Gaming. Now, you've probably seen it on a lot of other YouTube channels. You probably haven't heard about it recently. It was a big 2021, 2020, beginning of 2022 kind of darling, and it's fallen from grace ever since then. Luckily, I didn't get caught when it was at $30. I think I got in starting at about 18 and kind of trying to average down as this keeps going, but I'm not trying to overexpose myself too much. And again, I'll do a whole portfolio video after this video comes out, so you'll see what my actual positions are. But I own some Corsairs, the CRSR, and the thing is, though, is that because of 2021 and what they sell, they basically sell peripherals and they sell components for gaming computers, sort of streaming and things like that. But because they sell sort of that luxury item, premium item, it's getting a little scary, because if people stop buying luxury items, premium items, they're not spending as much. And like in this case, this year, people are sort of shifting their spending from buying actual goods to buying experiences, because people can actually go outside now and travel. So you're going to see it here on the the revenue getting hit pretty hard. The last couple of quarters, they've come out pre-earnings and announced, earnings are going to be less, revenue is going to be less than what we had originally projected and what we had originally sort of forecasted. So that's a little scary. Their creative peripherals and things like that, I love them. I think that they're definitely worth the premium that they're charging. I used to sell them, actually, not sell specifically Corsair, but I used to sell gaming peripherals and components and things like that. So I kind of saw what people were picking up, and I think that Corsair's only gotten bigger since then. You can kind of see what their market share looks like, and that's one of their big developments, is that their market share, both in the component space and in the peripheral space, they've been doing really, really well. But for me personally, the way I see this is AMD and Intel are going to be investing heavily into sort of the new technology, and a lot of that's going to entail DDR5 memory, along with new motherboards, new requirements for components and more power and things like that. So Corsair is going to have an opportunity to sort of get into that refresh cycle as people get new computers, get new components, get new technology into their computers, and maybe they already have some Corsair components in their computers that they can link up with the software and things like that. But again, the market share is one of the big things that I wanted to point out, because I think that in the component space, at the very least, it's interesting to me to see how much of a hold they really have across the different brands, because there's a lot of good different brands, but Corsair is able to charge a premium and keep that market share and grow it throughout the last couple of years. And along with that, you see the peripherals has been growing as well. So we love to see that. I really like seeing that. And the average selling price is one of the other things that I wanted to touch on too. The average selling price is pretty big compared to other components, and that again goes to show you that people are willing to pay the premium. They're able to, you know, even if they discount it, think about if they discount from their top price of what they're actually wanting, even if they discount it, it's probably the average price of another company. So you get to see that sort of premium branding and things like that. They're trying to build around their components, build around their peripherals, and they've been trying to attack the debt. They had a really successful year last year, and they used a lot of that free cash to pay down their debt, refinance their debt, and get into a better financial position. It's by no means like a financial fortress of any sort, but I think there's some opportunity here. I really like the branding. I like the company. Another thing that I wanted to mention too is that the GPU miners have kind of been selling off their cards. And you may think that this is a really bad thing, but actually what's happening is one of the big things that the CEO and really the management in general had talked about is that GPUs are so expensive that people weren't building new computers and they're actually holding off. So maybe people are going to get into computers now, especially if they're selling computers. They sell their own computers through Corsair from Origin PC. So you may see, you know, people start to build more computers, buy more components as they get a little bit cheaper, more reasonable, because they were selling for like 50% higher than MSRP for a lot of GPUs. And again, NVIDIA is going to be coming out with the new cycle of GPUs, and AMD will as well. So it'll be interesting to see what that actually does and what that actually can do for the industry going forward. One of the other things that I wanted to mention, and I mentioned it in previous videos, but I don't think I've mentioned it recent times, is the fact that they need to stabilize their costs. A lot of their costs have been inflating along with, you know, the sort of shipments, the oil, gas going up, all the input costs, the labor, everything that you can think of inflation-wise has been impacting their business model. And that is, again, shows at the gross margin level, and it shows at the net income level too. So you have to pay attention to the inputs of this and what's actually costing them. They're trying to sort of create synergies and find ways to do cost savings. But again, in the short term, who knows where it's going to go? The inflation's been killing a lot of businesses, not just this one. So it's going to hurt in the short term. But I think ultimately, for me at least, I like the opportunity here. I like the valuation that it's currently at. But again, it's not a huge position of mine. Like, it's not like I'm not making this like a quarter of my portfolio or anything like that. I'm keeping it reasonably sized based on the risk that is currently in the business. But what I wanted to mention is that the last thing really for the risk and development is that the biggest risk to me, at least from the stock point of view, is there's one partnership that owns half of the shares, or it's close to half of the shares, and it's Eagle Tree Partners. They own a lot of this company, and that scares me the most, because if they sell, it's going to bring a lot of liquidity to the market that didn't originally be, it wasn't there originally. So that could create a lot of, you know, downside pressure to the stock price. But again, if you believe in this company long term and you want it, it might be to the benefit of you, but it all depends on the reason for why they're selling. They were selling when the company hit 30, 32, 35, so was management, but it seems like as the company's price has dropped back down to earth, they're not selling. So I'm not sure if they will end up selling and maybe try to find a new opportunity for their own money, but that's a big risk, because again, there's a lot of liquidity that's not on the market currently, but it could be if they decide to sell. Now, their average ROIC is about single digits, mid-single digits, and their PE has been bouncing anywhere between, you know, 15 to 20, but it's going to go negative or not applicable depending on where you're looking, because the earnings have been negative over the last couple of quarters. So with that being said, their forward PE is about 14. Their enterprise value to EBITDA is about 60. So you're seeing like some weird disconnects based on the valuation and based on the amount of money that they are and aren't making. So it's a little scary. For me, at least, I'm trying not to build this into too big of a position. I would prefer if I would have waited to sell some puts on this, so at least I didn't have to hold the shares. If it dropped to a certain price, cool. But right now I hold quite a bit of shares, so I'm not going to be adding too much to this one unless we get some significant drops and the fundamentals get better instead of getting worse. So with that being said, the last one's going to be Carriage Services. Now CSV is that last one that I'm talking about, and this is one that I'm really interested in. One of the people in the Discords that I'm in actually talked to me about this, gave me a presentation on it, and I think the opportunity is there for me personally. I like I like everything about it. I just haven't done too much research in the industry or in the business itself, so it's a pretty easy business to understand. It's a funeral home business. Basically what happens is there's a lot of funeral homes that are privately owned, and CSV as well as SCI is, buying up these funeral homes and acquiring them, keeping the management there and letting them run it, but actually holding it all under sort of one holding company. So they basically have a ton of different funeral homes across the United States, and they're gaining a lot from it because people need funerals, people need cremation, different services. So you're going to have to use it one way or the other. And so what they do is they allow to sort of, people to use their funeral homes and things like that and give their services to them. And what I like the most about it is that the valuation is reasonable. The management is very conscious about their free cash flow. They're very conscious about their repurchasing of their shares. They have a dividend, but I don't really think that they should have one. They don't really need it. They're repurchasing shares the way that they are. But what I wanted to show you is that sort of at a macro level, you can see the demographics are shifting, and as more and more people get older, especially the largest generation, baby boomers, people are going to start passing away, unfortunately. But the thing is that funeral homes are going to have to take on a lot of this workload to be able to make sure that people are properly buried or properly cremated. So I think that there's some opportunity there, and as morbid as that sounds, really, and that's when we were talking about it in the Discord, I was saying the same thing. I was like, this sounds terrible that we're finding opportunities in something like this. But Peter Lynch found something similar, and I think it was SCI originally, but I'll have to go look back at one of his books and see if I can find actually what he was talking about. But the other thing I want to mention is the way that they look at this company. The owners who run it are actually one of the founders. He looks at it as, this is my business. What do I value it at? So their intrinsic value that they have given is about $65 to $75. I'm going to read it straight off of here, what they actually said. So he said, after we raised our roughly right range of intrinsic value by $10 per share from 65 to 75 in our third quarter earnings release dated October 27, 2021, we continue to aggressively buy our shares into the end of the year. Since our senior notes refinancing on May 13, 2021, we have repurchased a little over 2.9 million shares. That's 16% of the shares outstanding, for about $142 million or $49 per share. Now, the intrinsic value is increased to about $70 to $80. It says, so as long as Mr. Market Rodney Dangerfield continues to significantly undervalue the ownership and future prospects of our company, we will continue to prioritize share repurchases with the capital allocation framework of high return on invested capital, uses of free cash flow. So a lot of the repurchasing, and honestly, I cannot say this enough, there's no companies that are actually giving something like this. There's no one there that looks at their stock price like you should, how we as value investors do. They just repurchase shares because they're giving shares to someone else in their company, and they want to make sure that they at least don't have a complete outflow and sort of dilute their investors. So it is interesting to hear someone say, if we got the free cash flow, we got the money sitting on our balance sheet, why not buy shares if it's below our intrinsic value and what we estimate? And my estimation was really low compared to theirs and to the person who showed me. But I think that the opportunities here, it's not a huge business. I think it's like $500 million or give or take. I'm not sure what it's at today, but I know when I looked at it, it's about $500 million. But I think that there's something that might be there. I got to keep looking at this one. One of the other risks that I wanted to mention is that they have a lot of debt relative to the rest of their business sort of balance sheet. There's a lot of debt. I think it's about $394 million. So that's quite a bit, thinking relative to their market cap. But a lot of that you have to think is used for acquiring businesses. So if they have to acquire funeral homes, they probably don't have all this cash just sitting there. I think that over time, they're going to pay it down or refinance it and just keep using debt to properly acquire. And that's one of the risks, though, is that if you make an acquisition that's not good and doesn't do well, it'll cost you money as well as the debt that you use to finance that deal. So there is some risk there, as well as the management is getting a little bit older. They're starting to try to find a successor in place and try to build out the succession plan. Obviously, the founder is not going to leave anytime soon if he doesn't have to, health-wise or anything like that. But I just put here, there's a couple different things in the write-up if you want to look at it. I'm not going to try to go over it too much. Their average ROIC was about 3 to 5% over the last 10 years. Their PE currently is at about 11, and then obviously their forward PE is about 11, and their enterprise value to EBITDA is about 9. So I really like this. Again, they have a repurchase program that's about 13% of their current market cap. So and I'll pop up the repurchases here. You can see what they've done in 2022. They have about $488 million left to repurchase under their current repurchase program, but they keep authorizing it as they believe their company is undervalued. Now, let me know what you think down in the comments below. I'm really excited about some of these opportunities. CSV is one of the ones that I don't own any shares yet. I really want to research it. I just haven't had a chance to yet this last week or two. So that's why this video is coming out late anyways. But I just wanted to, kind of throw that out there because I think there might be something there, but I'm going to keep researching. And if I end up buying anything, I'll make sure to create a video and write up and everything like I normally do for some of my other positions. But I'm really looking forward to it. Let me know what you think down in the comments below. But with that being said, I hope you enjoyed this month's look, research, whatever you want to call it, quick overview. I'm really enjoying doing these, so let me know down in the comments below if there's anything else I should look at during the month that you guys might be interested in seeing. With that being said, have a great day and happy investing.